Peter, welcome back to Face. It's good to see you.
Thanks, Dale. Yeah, pretty good to see you too. Yeah, how are things with you?
Okay, Peter said that I look younger than him because of the time zone difference. That I'm 8 hours from Germany or something like that. So anyway, buddy, last time you were on, it was late November. We were trading around the 4,500 handle in the S&Ps, and at that time you were looking for a run to 4,900. It was a great call. We have stretched further than at that time you were looking for. And, trading is always assessing and reassessing. So where do you think we're at now?
Can you see my screen okay?
Yep. We have the S&Ps up here.
Ah, cool. Okay, that's good. Yeah, thanks. I mean, it's extraordinary actually how the markets have been running up so strongly. I mean, really, I think we have to focus in on what happened from last October, because of course before that, last year we had a run up, but we were still well below the 22 highs, the late 2021 highs in terms of the NASDAQ, and some of those traded in Europe. But, this particular run up, it's been pretty vertical. It's by far the strongest upswing that you can see, that began from really the October 22 low, so all the way back here. And I think it's coming to a termination point. Of course, we don't normally decide those things just on looking at the S&P. We tend to look at half a dozen of other stock indices to see how they're setting up in very similar patterns. But my conviction is that we are probably going to see a top this month. I mean, we're just beginning March, and we've got basically a good 20 days of trading ahead of us. But I think we might end up with something rather sooner than later, sort of in a top. Now, for those unacquainted with Elliott Wave, I mean, we're sort of looking at different corrective patterns. This upswing, when you look at it from October 22, you might think, well, that's a big uptrend, isn't it? I mean, aren't we sort of technically in an uptrend? I don't think so. I've always looked at 2022's decline as part of a bigger correction, and that we have a leg to the downside still missing. The sort of pattern that I'm really thinking of, and I've got something.
You still think it's a running flat?
Yeah, I think it's either running or expanding flat pattern. I mean, the distinction between those is just the C wave, how deep it is. Okay. But I believe that the entire swing up from 2022's lows is a B wave like this, of an expanding flat. So what we have to do in order to identify if that's correct or not is just to look at the three-wave sequence up. There can be variations to the zigzag. This is an archetype. Look at the expanding flat with a zigzag upswing from 2022. This is very atypical in the Dow, actually. I'll show you that in a moment. For the S&P, it's an expanding flat pattern. We put in permutations for the B waves. We can see an expanding flat that replaces the zigzag. So that's what's happening, I think, in the S&P and the NASDAQ. But the Dow is more atypical of the generic zigzag pattern here. But the important thing is to extend.
Looks like an ending diagonal developing in the Dow to me.
What, to the upside at the moment? In the short term, you mean?
Well, over the last few months, marginal new highs, looks like a wedge. Three drives developing, even if we made one more new high. And I wanted to ask you a question. I believe there's this analyst named Hughes, a real big macro, big picture guy, who's saying that the reason the market has been this strong, as you commented, is that it's bigger than the primary cycle. It's of a larger degree cycle. Do you concur with that? That this could be not your average typical primary cycle, but we might be in the super cycle.
No, I don't think so. No, I don't.
Not yet.
Agree with that.
Okay.
No, I don't think so. No, I mean, okay. I think it depends on your measure of what you think those things are. I mean, one of the big topics of the recent years has been the fact that commodities, and you can measure commodities basis the Bloomberg Commodity Index or one of the others, the Reuters, Thomson Reuters Index, whatever. But that, divided by the S&P, shows that commodities are at all-time lows at the moment relative to the S&P.
Right.
So people are saying, well, there's a new commodity super cycle about to begin. Well, what's technically a super cycle? Something that lasts, over a decade, probably sort of doubles in price, probably qualifies as that definition. But we're not in a commodity super cycle. I mean, you've only got to go back to sort of March, April in 22, and oil was at $130 and copper was making new record highs. I mean, that's not telling us that commodities are, rock bottom, as they would be if you divided it by the S&P over a very long-term chart. What you do see, actually, I think I've got an example of that. If we take a look here, here we go. Here's a very long-term look at the Bloomberg Commodity Index divided by the S&P, and you can see that in relative speak, commodities are very inexpensive basis that. But I think you have to flip it around a little bit. I think you have to say, hey, it's not commodities cheap, it's expensive. The S&P is expensive.
Right.
In relative terms. That's what, gold's relatively inexpensive if you look at it on a historical, inflation adjusted basis, compared to everything else. Asset prices are very, very expensive compared to what the return of income streams were, for example, going back to the 70s. I mean, and so I think it's all relative, but this is telling me that the S&P is way too expensive relative to commodities. But in terms of the S&P moving up, no, we're not in a new big cycle or anything. I think that's a bit too fantastical for me.
Well, that's why you felt that when the top came, it was going to be of a larger degree. Okay.
I don't subscribe to that idea. I think probably I mean, I can understand why people might think that. It's the same, but this is why I'm bringing in the commodity versus S&P relationship, because you start looking at things like that and you think, wow, there's going to be a new, boom, or we are in a new boom. But I don't think that's the case. I think in terms of the S&P, I still prescribe to the fact that we're simply in a finalizing fifth wave within primary wave 5's advance, which dates back to the financial crisis lows. The pandemic low was intermediate wave 4, so that's the fourth wave completion, and we're in the fifth wave. So we're not in a new super cycle. If you're in a fifth wave of something, you're not in a new super cycle, because that implies you're starting something new. Okay. By default, that thinking means that you're starting something new. We're actually in a terminal phase. If you look at it from the perspective of 2008, 2009, we're in a terminal phase. We're not in a new growth phase. If we have to think about these things in relation to what history's provided us, if you take a look at the NASDAQ over a long-term period, we're actually encompassing a new technology era similar to .com era, and it's probably got it's got legs to go.
.com. Yeah,
it's definitely got legs to go. So and normally in the last phase of something like this, you get very high multiple returns, which is why you're getting Mag 7 doing extraordinary things, FANGs 10 doing extraordinary things, and Super Micro, which was in the news, wasn't it? Super Micro this morning.
SCMI.
Yeah, and who are going to be part of the S&P soon, and of course that stock's gone up $100 overnight. I mean, these things are extraordinary, so it's not to be ignored. But are we in a prolonged new long-term super cycle in the S&P or technology? No, we're not. We're in the last stages of it, but it can do a lot.
Well, that's what he meant. Last phases. He's not saying it just started. He's looking at it this being terminal too. I don't know if he has
Okay.
targets at 7,000.
Okay.
You know, you have we were talking about yields in here today,
Hmm.
and we have like this rectangle, and I know you have a bit different view that there's going to be some action in yields that's going to confuse market participants. And you're of the mind that that high that we had 435, which was what, about 38% back, not quite 50% back, that was it at 435. Is that your view?
This rally that we've seen since end
Yeah,
December, you mean? This end
yeah,
December rally.
yeah.
Yeah, that's interesting. I mean, I think that I was hoping actually at the end of December that 378, the low at that time, was the end of intermediate wave two, and we're going to get yields turning up really in a more impulsive way. Actually, as it goes, the rally looks rather corrective. If you take a look at the very short term, look at the 10-year Treasury yields, yeah, you can see that the initial upswing is a three-wave zigzag, A, B, C here. Now, it could
Okay.
have been, and I did think at one point it might have been a fractal 1-2-1 pattern, 1-2-1. But when we saw this decline towards the end of January, it broke that secondary low here. So that means we can't count up 1-2-1-2. So we can't have begun intermediate wave three's uptrend from that low. It's not possible. We get this
Okay.
very strong decline, almost comes back to the low from the end of December. And then we get a five-wave swing up like this. And we can extend the zigzag that unfolded before by 38%. And we hit that exactly, and it's responded down.
Okay. So
So
you're looking for those lows in February and last year to be taken out before the resumption of higher yields.
I think so. I mean, I haven't taken a position long of T-notes at the moment. This is the yield.
Yeah.
I haven't taken a long position of T-notes yet because I wanted to see it have a more demonstrative breakdown, and then I'll jump on its back, and then we'll take it down to maybe 358 in the yields, which I think from memory was probably going to be about 115 and a half on the T-note futures. But I haven't done it yet. You can see if you go into the microstructure, you get a sort of an impulse decline here. You get a straightforward decline, then you
Yeah.
rally, but you get three waves down here. So I'm thinking that there might be a little bit of a running or expanding flat pattern. So this is A, three waves down for B. We go up in 5 for C in the next couple of days, and then you start getting it. So if this swing up occurs like this in 5 waves, don't be alarmed that it's indicating a break above here. It won't. It probably will fail to break above there. At least it will fail to break above here at this. So it will go up here. And then if it starts to turn down again and you start breaking below here, you can probably initiate your T-note buying on a yield break below here. And then it should drop down to 358, I think, somewhere down to here. I'd like to see that hold.
Yeah.
That's going to be an important level to hold above the old April 23 lows here at 325. If it does that, and for example, if you're looking at that and you get the corresponding yield pullback in the bunds, and it doesn't, and the bunds, I think at the moment, we don't expect a break below the end December low on those. I think we're looking at a pullback lower, but not a break below the end December low. So that means you've got a little bit of T-note outperformance relative to the bunds. So if you get a little bit of outperformance in T-notes, in other words, T-notes go up more than bund futures go up. That's why we talk in terms of outperformance in that concept. And this doesn't break that low, then I think the setup's perfect to turn around the positioning from a long position to a short, and then we can take the next yield push to the upside. But I have to say that for those of you who are a bit familiar with Elliott Wave, looking on today at some of these charts in the yields, one of the reasons why I think yields are going to go up this year and confound the consensus opinion that they're traveling to the downside is simply because when we first identified this push up from March, April last year, we never got really a 5-wave structure for primary wave 5. And we scratched our heads and said, well, where is that 5-wave structure? It should have been subdividing into a 5-wave structure so that we could get to our 3% numbers and get to sort of 5% in the 10-year Treasury yields. But even in 10-year Treasury yields, we never got really an equitable 5-wave structure. I'll go back to the 10-year Treasury yields to see it again. But here you can see the movement up. Where's the 4th and the 5th wave? Didn't develop. It's only 3 waves up. And we're also looking at things like BTP yields in Italy. And you get the same thing. Now, if you go to the BTP yields in Italy, from last year's lows, retracement lows, we have A, triangle, B, C up. There's only 3 waves up to the highs that we saw in October again. And then we get this straightforward drop. Well, 3 waves up like that, again, A down, 3 waves up for B and C. That's an expanding flat correction. So we've had a sideways correction all the way for wave 4. This should be breaking up this year. So when we saw the latest Bank of America survey in December and January, we had a record amount of fund managers saying that they expected yields to continue moving down this year. And it was 2 standard deviations over the previous record high in that survey, which was in basically, I think, October, November 2008. And at the time, of course, that was the lows, getting towards the lows in the financial crisis. And if you take a check look at what 10-year Treasuries did at that time, so you go back to, let's go back to the monthly chart and 10-year Treasury yields. Yields actually went up from 2% here
to
4% up here by the first quarter of 2010.
Okay.
So that's another compelling reason why I'm a bit concerned that too many fund managers are talking about lower yields this year. I think we've already, the market priced in 150 basis points of rate cuts. That's in dollar terms from the Fed by end December. And we already said, well, that's way too much, even for the optimists. But since then, we've been pricing out, of course. And now the investment banks are quick on the heels of pricing out at least 25 basis points, maybe 50 basis points. And they're only saying now, well, we can only consider a rate cut by the Fed by June. I think that as time goes by, they will price that out completely for this year.
How about a hike? That there are some people saying there's a 10% chance, 5% chance that the Fed tightens one more time. With what markets are doing, they could afford to do it without causing any huge harm. Maybe the employment numbers are still going to be okay. But I want to shift because a lot of people are talking about the action we had in gold on Friday, Peter. As that is a breakout, it's a cup and handle. We're going to 2150 and then 23 and then 25. I'm interested in what you think.
Okay. I'm really bullish for platinum and palladium at the moment. I think they've hit bottom and we're buying a lot of platinum and palladium.
Because the gold platinum ratio has not it's gotten even wider, hasn't it, in the last few months? So it might be close to the lows that it's been over the last year or so, right?
Yeah, I think so. I mean, I think the ratio is very extreme. I really like platinum and palladium. I think they're giving me some really nice patterns, some really nice signals. We'll have a look at platinum just quick. Let's put it in here. And
now this doesn't mean that people watching this interview and video go out and steal catalytic converters, right?
I think they've all been
big business now.
I think Volkswagen ripped them all out anyway. I think they're running on leaded petrol these days, those cars.
Okay.
But I actually think that in terms of platinum, we've had over the last couple of years this correction down in wave X, new uptrend for primary wave 1, a really nice expanding flat pattern after that, which got down into this low here, which we saw back end of last year, November. Then we saw a nice 5-wave advance again, and now we've seen another expanding flat pattern. So this is self-similarity or self-affinity, because you've got an expanding flat intermediate wave 2, an expanding flat for primary wave 2. So you've got self-similar patterns concurrently running afterwards. So this is a really nice fractal idea of self-similarity. And last week, I think we traded down to 863, and we've basically pinged a new buy signal on this. So I'm really bullish for platinum, but I'm a bit concerned about gold. I have to admit, because when I look at gold, take this drop that you see down here to into December's low at 1973, the following advance to 2088. Well, that's definitely only a three-wave action. It's a zigzag. That's weird. I mean, shouldn't we be in a new bull market? We should be developing into 5 price swings. Well, that definitely measures as a zigzag. You could say, right, well, then we do what we talked about earlier on the T-notes, on the yields. Maybe this is 1, 2, 1, 2, but no, this decline broke below the secondary low here. So we can't get a fractal super bullish pattern out of that. And that worries me. That worries me. I don't know why we've got 3 waves there. I mean, we can't ignore it. We can't just say, okay, well, let's ignore it and let's just buy gold. Platinum is going up, gold will go up. Yeah, it might do. I'd feel much more comfortable buying platinum. And for the fact of the matter is, I think platinum basis, the platinum gold ratio is going to outperform gold anyway. So it makes absolute perfect sense to buy platinum. But I'm a bit hesitant to say, at least to our subscribers and our clients, to buy gold at the moment, because that 3-wave action, it worries me a bit. So I think what might happen is that we might have a zigzag, a double zigzag. So this would be the first zigzag. This is X. And then we get a secondary zigzag. If that's the case, it will probably hit 2116. So it won't break into new highs. And then it will flop down. And this secondary zigzag here will be replicating this first zigzag here. So we'll end up as a double zigzag for a second wave pullback with a rather elaborate double zigzag in the X wave. So I think it might work like that. And in which case, that could explain why we're seeing platinum and palladium push up a little bit early ahead of that. So that
why not silver? Silver's white. It's a white metal as well, and the gold silver ratio has been showing gold outperforming silver. There were a couple of fake signals on that at 87, but right now the gold silver ratio still looks okay.
Yeah, this is gold silver ratio.
Yeah, okay.
And I think there's a squidge up left to about 92, 92 and a half.
Okay.
For this to run up. This needs to be a zigzag in wave 5 of this diagonal, which I've put, this is my worksheet on some boundary lines. But, so we need a little bit of a pullback here, and then it needs to trade up to about 92, 92 and a half. Now, if you go to 92 and a half, I've got a silver downside target at $21 at the moment. So if anybody's got handy a calculator, you can multiply 21 times the ratio. What did I say? 92 and a half, let's say.
Yeah.
Times.
And that's 92. How you come up with 1950, 1960 gold.
Yeah, that's right. That gets to about 19 on the calculator. That comes to 1940. So I think 1950 is a strong probability. I'd like to see that. Would I buy gold if it broke above 2135? Yeah, I probably would. But I have to say my main position is on platinum and palladium, on those two. I think there's a lot more upside potential when we're trading these, and you can also trade these on ETFs nowadays. So I think PALL is the symbol for palladium, and I think they're much better prospect.
Okay, it's a little disappointing for me to see this, because last time you were on, I asked about the miners, and they were just sitting there. They, they dropped another, like Newmont dropped another 30% since November, and the GDX did, and many of the miners, and it's really kind of an accessible way for the public to participate in gold. So we had a reversal week to the upside in many of those issues. But if you're right, all we do is have a rally to 21 and a half.
Yeah.
Okay, so
well, this is Newmont Mining. It's big underperformer. It doesn't look like anything like the other miners.
Yeah.
So this is
okay. So there's more left. So we're just going to have a rally, and we're not going to complete until April. So the reversal week that we had in things like GDX, which held prior lows, the lows from last week and the reversal week are just setting up a little bear market pop before
well, yeah, they're pretty low, as you can see that it started to revisit this previous low that we saw in October. Generally speaking, we're long of all of these miners because they're going to be outperforming gold bullion anyway to the upside. So, and I think it's much better for private investors to trade the gold miners because you're basically by nature deleveraging. If you're trading gold futures, you know you're inclined to get yourself into a bit of a mess if you're not very, very clever at managing your risk reward. So you remove a lot of that pain by trading the outright gold miners because you're not trading these leveraged. And we're already long a little bit. We had a look at it again this week, and we felt that this is a running flat, and this might just squeeze out a tiny bit low, below 25.68. But as you saw on Newmont Mining, they're basically finishing. They're not really going anywhere. These big trends we confirmed, back in 2022 as bottoming here.
Yeah.
So we've run up nicely in that corrections, and this is just a correction down. And you just have to be a little bit more patient, I think. I would be buying these today. Yes, I would, because basically where you look at the sheer amount of multiples to the upside are huge.
Okay. I could understand how perhaps a dollar could still rally with falling yields here because they're also going to be falling in Europe. But what do you think could take the gold back down to 1950 if you're right about yields peaking up here at 435 heading towards 360?
Well, I think the dollar just pop up to 105.80.
You think that's going to be enough to take it gold down to 1950?
Yeah, I
okay.
think it will be enough. Yeah.
Okay.
I think that should be enough. I mean, you're looking at swings last week. Prior to that pickup, because of it was because of the ISM manufacturing numbers coming out so weak, everybody suddenly got a little bit, swung around into sentiment, thinking that the Fed, that's basically, a reason for the Fed to cut rates early again. And of course, it's all swinging around that idea. But you can see on this graph, it's hardly moved.
Yeah.
So if you're going to get a move up to 105.84, that's going to knock gold down enough.
Okay, but we have to hold the 340. I've been looking at 103.80 on a closing basis. We've traded underneath it, but we haven't closed under 103.80 yet.
I think 103.43 the week before where we saw that. I think that's really important. I think that one, even if it broke below that, I don't think it will, but even if it did break below that, it's not going to break below wave X low here at 102.77. But I think this is just playing games with us this little bit. I think sooner or later this week you're going to get a pop, and this is.
I made a video Friday, Peter, where I was talking about how stops are building up under 108 because in euro because it keeps holding 108. And then the ISM came out, and all of a sudden I had a clown hat on. So anyway, I still think 108 could be taken out. And
you mean when you say 108, you mean 103.80?
No, 108 in euro.
Oh, in the euro. Okay.
Yeah, in the euro. It's held 108 like for 2 weeks. See. I'm sure every euro bull has their stops under 108.
Mm-hmm. Yeah, well, I think I think that you're right. Yeah, if it breaks 108, it's a clear signal to go with it. Take it down to 106.25, something like that, and then we're done. But yeah, I mean, we're not quite ready yet. Finishing this correction downside from end December, we've got a bit more to go. It's just a question of does it accelerate down immediately without taking out 108.90, or is there some little twist there? Which I think if it broke above 108.90, I might be inclined to relabel that as wave X, as an expanding flat, 3 down, 5 up. But you're definitely going to get another swing down on the euro. In other words, a little bit more dollar strength before we have a much bigger impact of the dollar declining.
Yeah, because I know that's the big picture for you.
Yes, I think.
Doubt.
Yeah, once we've got, let's stick to the euro, but once we get down to 106.25, we're really looking at a major new uptrend. Because don't forget, going back here to sort of October 22, we've had 5 waves up for primary wave A, really nice expanding flat pattern, 3 up, down 5 to complete wave, primary wave 2. We've had a 5-wave advance into the end December high at 111.42, and now this is just a correction. Once that's finished, this is going to really accelerate. So we've got to be starting to think about now themes which are going to weaken the dollar. You know, this is what are the things that are going to be the themes that are going to weaken the dollar? Is it going to be the fact that the US Treasury have got to issue up to $2 trillion worth of more debt this year? And people are just going to start losing faith in holding dollars. I think we've got this theme of de-dollarization, which is going
Egypt
on.
Egypt was last. Egypt made it illegal to use dollars to support their currency.
Right. When did they do that?
I think a couple weeks ago.
Okay, so yeah, when I was in Egypt last September, I was carrying around euros, and my colleagues, my friends there, were carrying dollars, and they were preferring euros at the time because the black market for euros apparently was twice as much as what the exchange office, the local exchange office gave. I'm not sure. Yeah, that was a bit strange. That was we didn't experience that before, but so they're quite. But there's a very, very strong black market in currency trading there. I mean, yeah, you need to be a bit careful though, because it's discouraged on the streets. Obviously, you don't want to be a tourist and getting caught exchanging stuff like that. But there is a black market that's going on, definitely. Yeah.
Okay. Well, Peter, again, we've been talking for so many years now, going back to the old FX Street days, and I always appreciate having a conversation with you, and want to thank you for coming in and edifying the community here in FACE and anywhere else we talk. Best way for people to hear more about what you do, because this presentation is just the tip of the iceberg.
Well, thanks, Dale. Yeah, it's always great to connect with you because, yeah, no, it's you and I, we come from similar backgrounds and we understand things, and I think that's helpful. Oh, sorry, I'm just showing the wrong screen here. But just to say one thing, thanks for the opportunity to share a little bit. We've every year we around sort of December onwards into early February, we produce a trilogy series of reports, stock indices, commodities, and the third in the trilogy series is currencies and interest rates. We've just finished the currencies and interest rate one. This is what it looks like on the surface. I have to say it's a mammoth report. It's 194 pages. We go into a lot of currencies and cross-currency pairs, which you'll see in this part of the menu. And the second section is interest rates. I'm looking at US, Europe, and a few other areas around the world. So if you're interested in that, please go to our website, which you can find here, which is wavetrack.com. And you can find the trilogy series in the top right here. So you can click on these and it will open up into our blog. And this shows you details how to obtain those. They're really in-depth studies. They are long to medium term. If you want something shorter term to see how those fit together, you can actually go into our products and services, our registration subscription. Sorry, here we go, into subscription, and we have a bi-weekly report which is called the Elliott Wave Compass, and it has a lot of those different markets, including stock indices, FX, commodities, and the interest rates. And you can subscribe here. So that comes out twice a week. It's quite detailed study work, but it's basically short term. So yeah, that's a good way of carrying through with some of the work that we're doing here. We'd love
Would
to
you,
see you.
yeah, would you take profits in Bitcoin right here, Peter? Or I'll leave it with that. It's been a hell of a run.
Yeah, it has. I was looking at it this morning actually, and
up another 2 grand every day. It's up another
yeah,
four-figure move.
yeah. I thought initially that it might have blown itself off last week when we saw that initial run up to this 61.8% area. I've extended waves 1 to 3 by 61.8. Bitcoin actually could extend a bit further to this week now that it's broken up.
Another
I'm waiting to
grand.
see if it could get up to 69, up to that area. Then I might be shorting it because it's very overbought. And if you take a look at the, I think the slightly
it looks
bigger
like
picture.
NVIDIA,
yeah. You can see there's a bit of bearish divergence coming in. NVIDIA, I've got a target that will make people rethink. I won't give you, I won't show you what I've got on NVIDIA because it's in the Compass report.
Okay.
And I'd like people to actually see that and read it a bit more closely, more than the time we've got now. But yeah, Bitcoin anyway should do something like that. So yeah, if you can subscribe, join us. We'd be happy to have you aboard. Yeah.
Peter, thank you, my trading warrior brother. I hope 2024 is great for you and your family, and not just in the markets, but in every way.
Thanks, Dale, and same to you. And good luck with everything there. And just to say that thanks for inviting me. You're doing a great job, and we'd just love to hear your voice.
Peter Goodburn, everybody, check him out. He's part of my intelligence gathering. So that's a wrap, everyone. Someone said that you're a Elliott Wave master. I believe it was Khalid, who is an Elliottian himself. And people are thanking you, Peter. And I thank you and look forward to talking to you late spring.
Thanks very much, Bill. Looking forward to that. And thanks, Khalid and the guys. Give me the thumbs up. I appreciate that. It's really coming from you guys. I really appreciate it, really much.
Good hunting, my brother.
Yeah. God bless everyone. Bye for now.
That's a wrap, everyone. Don't just count your waves, count your blessings, and you could join the team in 7 minutes on the morning edge. Think about what I said with the intention of peeling off some profits this week and planting good seeds and helping people out with a piece of that, and having a field full of seeds that grow so that you could have a bumper crop to reap. And that's a wrap. Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.